Welcome to another episode with Loans Elevated. My name is Broch Lassig, top 1% loan officer nationwide.
And I'm TJ Heidenreich. Together we bring the latest news, strategies, and insights in the mortgage and real estate industry.
So there are some major shifts happening across all types of residential mortgage financing. We're going to talk today primarily about the conventional Fannie Mae and Freddie Mac changes and contrast that with the FHA changes that have recently come to the table. There's other ones like with VA and different things. There's a lot happening in the industry right now. So we're going to do our best at highlighting that over the next few episodes. But this one in particular, we want to talk about conventional and FHA because this affects most homebuyers are going to be using these two programs.
For sure. They're called LLPAs, loan level pricing adjustments. That's the number one thing that we're going to be talking about first off. For conventional. Yep. And the way you obtain an interest rate is there's a bunch of different marks. You have your credit, you have your loan to value, how much you're putting down, and you have your debt to income ratio. Now, which you didn't have before. Debt to income
ratio used to not be had nothing to do with this equation.
As long as you qualified for the program and you could get an automated underwriting system approval, it did not matter.
Didn't matter. So that's one new feature, which is crazy. We'll talk kind of about why that's important. Yep. But it used to be, and on basically every other program besides conventional, it just boils down to what's your credit and how much are you putting down. Yep. Some programs don't even care how much you're putting down. It just matters about your credit. And sometimes some programs like FHA actually, credit's not even that significant, or down payment, which is
other
crazy.
Than, of course, you had few select jumbo programs that debt to income ratio did matter, but that wasn't standard financing.
Yep, on just jumbo stuff, not conforming. So let's just dive down, do this compare and contrast. Yep. So on conventional, like TJ said, the loan level price adjustment changes. So what this means is you have a mortgage, like everyone has a rate sheet, and the rate sheet has what is referred to commonly as a par rate. So the par rate is at one rate. And then they bake into account like, okay, there's a table. You can Google this, Fannie Mae loan level price adjustments. You could find this table for yourself. But basically you say, okay, I've got a credit score of 720 to 740. And I am putting, I've got a loan to value ratio of 90.01 to 95%, which is, that's a loan to value band and a credit band. And you would figure out, okay, I've got a hit on the credit, I've got a hit on the loan to value, and those two combined result in either a discount fee of, let's just say, for example, you had a 0.5 hit for credit and a 0.5 hit for LTV. So at that, what would have been the par rate, you now have, because of the loan level price adjustments, you have a discount fee or a buy down of 1% in this hypothetical scenario. That is what a loan level price adjustment is. Those are changing dramatically. And I think you had this pulled up, TJ. Let's kind of go over what's changing and how significant this is. Oh, actually, I had it pulled up here. Yeah. So this is on a purchase. What we're seeing is, and we could send this to you if you want to see this, like the changes, but it's pretty crazy because what we're seeing is if somebody put 20% down with a 780 credit score, so this is really a prime optimal buyer on a primary residence, your rate would actually be worse than if you put 5% down or if you put 3% down. Your rate, depending on income, could be worse by putting 20% down. That is so counterintuitive and backwards. But then in addition to that, the person that puts 5% down and has a 660 credit score, way worse credit, way lower down payment, frankly, a bigger credit risk, a bigger risk to the bank, their rates through these changes are getting dramatically better by 1.25% better. So on like a $500,000 house, we're talking $6,250 cheaper for that person. And for the highly qualified buyer, it's getting worse by like $2,500 on the same house.
Yeah, that doesn't make a whole lot of sense. I mean, I feel like it's government trying to help with lower income and lower credit to qualify it, but it shouldn't take away from people that are conscious about their credit and are putting more down. Yeah. Why should they suffer from it?
It's having a counter effect.
It's totally
and what you said is 100% accurate. Yeah. I mean, they've come out and said their initiative, which is why in the past, many of us saw investment properties getting more expensive, second homes getting more expensive because they're on this run to reduce or I guess exchange the return on investment to charge more for evidently higher qualified buyers, but also people buying investment properties and second homes to free up additional risks and make things cheaper for less qualified people. And their goal is to empower more homeownership, empower first-time homebuyers to have more access to homeownership. So it is really, it's a really good, I think, concept. I would love to see first-time homebuyers have a better opportunity and not a disadvantage compared to other people, but it shouldn't come. I think it's frustrating it comes at the expense of people that have, because there's a lot of first-time homebuyers we work with that have 10 to 20% down, have a 780
They've been working
score,
on it for years,
saving and just like sacrificing and getting all their debt
checking
paid
their credit
off.
karma once a month just to
and now they are penalized, and the person with lower credit with no down payment that's reckless with their financing is the benefactor of their penalty. So I don't know, I'm a little frustrated by it. I think there is some benefits for certain people. Now dive into the debt to income ratio hit.
Yeah, so before we could run our debt to income ratio all the way up to 50%. Nothing would change in terms of the loan level pricing adjustments, and everything.
In other words, nothing would change on the mortgage rate.
Yep, nothing changed on the rate and or on qualifications. Now, if you have a debt to income ratio of over 40%, you're going to be charged 3/8 of a point. That's going to make it difficult because the lender is going to have a harder time qualifying you based on the property you're looking at. Because if your debt to income ratio is going to be over 40%, your interest rate is going to be different, or you're going to have to pay more for that same interest rate. But then this also dives into if you're on the fringe of that 40% and properties differ because of property taxes
or HOA
or
insurance
something.
or whatever.
I mean, every property is going to be different. So you need to make sure your lender is doing their homework on the exact property that you want to put an offer on to make sure you're under that 40% DTI mark in order to be getting the best pricing available.
Yep. So it just adds an additional fold that really you need a lender that is experienced, knowledgeable, paying attention to this stuff so that you are sure you're getting the best deal. And there's so much to it. So that's a complication. Now, another thing that I pulled up today, which I don't know what to think about it because it's the same entity, for example, Fannie Mae, that is rolling out these loan level price adjustments, favoring lower credit scores and higher loan to values. It's literally favoring that, it's incentivizing lower credit scores and higher loan to values on Fannie Mae's programs. However, just today we got notification that AUS, which is automated underwriting system, it's a system that's run on every loan. There's also manual underwriting, but I don't know.
Manual underwriting is very rare.
Are going to be automated underwriting. They just announced some changes on automated underwriting through Fannie Mae as well, the same entity, that there are going to be issuing fewer approvals, namely for people with lower credit scores and higher LTVs. I'm like, what?
So they're incentivizing you to put less down, but now you're going to get less approvals with putting less down.
Yeah, their system's going to issue fewer approvals for those same borrowers that they just incentivized. It's not going to issue fewer approvals for the highly qualified buyers doing 5, 10, 15, 20% down with a 780 credit score. So call me a conspiracy theorist, but I'm like, okay, now they're trying to look good on the surface by, quote unquote, making affordability better for, maybe underserved borrowers. Yet they're going to approve fewer of those. They're going to continue approving the ones that they're now making the loans more expensive on. I think it's a money grab. And it's a dangerous thing because they're legitimately just going to make more money on the people that they're going to qualify for, and they're going to qualify fewer of the people that they supposedly made it cheaper for.
For sure.
It's insane.
It makes no sense. Luckily, though, FHA has stepped in with lowering MIP.
It's funny how the timing works here. And all of these, just so you know, we got to figure out what's going on. All of these are government-sponsored entities. All of these are entities that are majority owned on Fannie and Freddie and completely insured and managed by the government.
Yeah.
All of these programs are. And within the same, 2-week period, these changes come out.
Yeah.
So FHA, let's talk about what they rolled out, and it is very, very beneficial.
Yeah. They've lowered their mortgage insurance premium by 0.3. Previously, you ran the numbers today on the average.
35% savings.
Yeah, 35% savings. Do you remember the exact numbers on that house you ran?
On a $450,000 house, the monthly savings were $108 a month.
It's stupid. So that means if you want to take those savings and apply it towards obtaining a more expensive house, that's like $15,000 to $20,000 more home you could afford
for the exact same payment. So this is super powerful change.
Yeah.
I mean, I'm digging FHA. And the crazy thing is in the industry, over long periods of time, we're talking 30 years, there have been ebbs and flows to more loans going to FHA, more loans going to conventional. Right now, we happen to find ourselves in an era for a long period of time, 10 years, maybe longer.
50-50?
It's way more conventional.
Would you?
Than FHA.
I think I'm more so 50-50.
Are you 50-50? Yeah. So my business is like 85% conventional. And I think just broadly across the industry, there's more conventional than there is FHA.
Yeah.
I think this is going to turn the tables. So they dropped the MIP. The other cool thing about FHA, all of this crap about limiting approvals for lower credit scores, higher loan to values, all of this stuff, FHA doesn't care about that. Like, you can have a credit score of 600 and do a 3.5% down payment, and you have the same rate as somebody that has a 780 credit score and put 20% down on an FHA loan. So it's like, that is powerful.
Yeah, and I think this will be good for nationwide. There's been a negative connotation, I'd say, with an FHA loan for a long time. And I think mainly because sellers, when the buyers are looking to buy a house and they have an FHA loan, the appraisal is a little bit more strict on an FHA.
There's minimum property requirements, which are really misperceived by most of the market. There's little tiny things like, for example, you have to have a handrail on the staircase on an FHA. That probably won't be called out on a conventional. So it's stuff that's really not a big deal. Cracked window, you can't have that on FHA.
Peeling paint, little stuff.
Silly stuff. Oftentimes realtors just don't want to deal with the pain of it.
Yeah,
and so they won't accept the offers.
But
definitely. Then also, I think where you're going with this,
with mortgage insurance permanently is what I was going to go with.
Yes, 100%.
So even if you have over 20% equity in your house, you still have mortgage insurance on your home for the life of the loan, unless you refinance into a conforming loan.
Yep. So that's a major drawback. You can't ever get rid of it. However,
but if you're putting less down, sorry not to cut you off, but if you're putting less down anyways, it might make sense to go with an FHA loan due to what they've changed.
Yes. And I want to tie this up because we're kind of bouncing around on the FHA component. The lifelong PMI is a problem. However, a lot of clients and even industry people get themselves mixed up and confused thinking about things that don't actually matter. Like, oh my gosh, the interest cost over 30 years, that's going to be so much money. Or, I have PMI for 30 years, whereas on my conventional, I could get rid of it in 9 or 10 or 11 years. That is pretty much, it's a false, fear, because the average homeowner is going to change their mortgage every 4 or 5 years is the statistic. So it's like, no matter what, you're going to be paying the PMI the whole time you're in either of these loans. I wouldn't fret too much about the lifelong PMI. PMI is, for a lot of people, is tax deductible anyway, so there's benefits. One of them, in my opinion, the biggest detraction from FHA compared to conventional, which is something you need to pay attention to, is the upfront mortgage insurance.
Oh, yeah.
So on FHA, you have upfront and monthly. On conventional, you only have monthly or upfront. You could choose. So that's an added expense on an FHA that you could otherwise avoid by going conventional, and it's significant. It's 1.75%. So it's thousands of dollars. Now, they allow you to finance it in the loan. And one cool feature on an FHA, you need to pay attention here. This is very, very significant. There's a streamlined refinance on an FHA, which doesn't exist on conventional, no streamline whatsoever. What this allows you to do is refinance your FHA loan with no appraisal, no income, no credit documentation. You just basically come in and we process a lower rate, essentially is how it works, lower rate in payment. But the cool thing about that streamline is that upfront mortgage insurance premium you paid, you'll get a refund of any unused portion of that when you refi on an FHA to FHA mortgage. So you can save some money on it. And again, it's tax deductible, but it is an expense that you wouldn't face on conventional.
Right.
Now, why don't you go over the numbers that we ran, how surprising this is for the people that historically, up until recently, would not have ever considered an FHA loan versus conventional. For
sure. So we ran numbers at a pretty good borrower. They were, 740 FICO, putting down 10%, $450,000 purchase price.
And 40% DTI.
Yeah.
So
exactly.
We're running it to be
best case scenario for a conforming borrower. On this, their interest rate was going to be 6.75%, and they were going to be paying monthly MI of 0.27%. On the FHA, it was going to be 6.25% rate and 0.5 MI. So even though FHA in the past has had that negative connotation behind it. It's still cheaper. Even with this perfect borrower.
The crazy thing is, a month and a half ago, you and I, on a 740 FICO, 10% down, not even for 1 second would I have considered FHA.
No, I wouldn't even have ran it. It would have been...
Not even thought about.
Yeah.
And now it's something you really have to consider.
Yep, exactly.
So again, you've got to have a lender that is paying attention to this
Looking
stuff
at
and
it
knowing.
all the time.
Yeah, because these trends are changing in a big way. But that would save that borrower 0.25% annually in the combination of mortgage interest and mortgage insurance costs. That's significant. Depending on the loan amount, that's a lot of, that's $50 to $100 a month in savings on the FHA loan. So that's significant. But
you just have to make sure, you have to run the numbers to see when your break-even point is for the upfront MI to make sure it all makes sense.
And that's what, I mean, just to drop a little bit, we do an extraordinary job at that. Like, we don't favor one program or the other. We favor getting you as the client the very best deal possible and looking holistically at all the details, not linearly at like, well, what's the lowest rate? Well, in this scenario, FHA would happen to be the lowest rate. But when you add the PMI, what's the difference? When we calculate the upfront PMI.
Really understanding your goals too. Like, oh, you're only going to be in this house for a couple of years. Maybe you don't go this route because the break-even point is 3 or 4 years.
Right, because of the upfront PMI or whatever. Yeah, so I don't know. We wanted to share some information so that you are aware of what's going on and how dramatically the landscape's changing.
Yeah, for sure.
But you really need to lean on professionals like our team to make the right choice, because there's so much that's always ever changing, daily, weekly. I mean, it's a crazy business. So anyway, hopefully it's helpful. Thank you guys for tuning in.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.